Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes.
Okay, so today I wanted to talk about, young entrepreneurs or young business owners and sort of building wealth outside their core business. I often get asked as to what's next. I've got a great sort of cash cow of a business. I've got a great business that sort of built me a bit of wealth. And what should I really be doing with this money? And, if you're a young entrepreneur, chances are most of your energy and money is actually tied up in your business. Probably makes sense. And, it's your baby, it's your biggest asset. It's probably the best investment you've made or you've got. But it's a risk because, what happens if business slows down or worse, doesn't go to plan? Too many young entrepreneurs sort of put all their eggs in one basket and forget sort of to build wealth outside of it. And I believe that's where sort of financial freedom starts to slip away, because if you're sort of too focused on your own business, chances are it can very quickly slip away. So in today's episode, we're sort of flipping the script. Instead of me telling you what to do, we're running through sort of some key questions you should be asking your accountant and financial planner. Questions to help you sort of grow wealth outside your business, sort of protect what you've built and set yourself up for a long time. I've structured these sort of questions as to questions that I frequently get from our clients and sort of what they should do and the biggest mistakes to avoid to make yourself covered in the long run. So I'll first start off with a question to Stuart. Sort of the one that I get the most is, should my focus first be on property, shares, or a mix of both?
And it's a good question, Mena, because, they're obviously the two biggest asset classes, and it depends on who you ask, of course. You ask someone that's built a lot of wealth through property, they're going to say property. If you go and ask a stockbroker, no prizes for guessing what they're going to say. I don't think it's a property versus shares decision. The way I'd like to reframe it is to say geared or ungeared. So if you're going to borrow to invest, property is typically the best way to do that. If you're not borrowing to invest, probably shares is more appropriate or suitable. And the reason for that is just the attributes of return and the ability and cost of borrowing. So we know it's easy to borrow to go and buy property. If you've got equity in existing property, you can go and borrow the full cost, so you don't have to put any money in. And the cost to borrow is typically much lower than what it is to gear into the share market. The other thing too is that mortgages don't have margin calls. So unlike share market investments that are geared, if your share portfolio falls, you might get a margin call, which means you are required then to reduce the loan to its maximum loan to value ratio. And that's a problem because if the market's dropped, you don't want to be selling stocks at that time, and you might not have the ready cash available to reduce the debt. So you don't have that risk with property. With shares, the benefits are that you can buy incrementally. They are pretty hands off, unlike property, they're not going to require much of your time. You don't have tenants or land tax or any of these sorts of things, and they're highly liquid. And so that's the way I'd like to frame it. I guess the question then, to answer the question, geared or ungeared, really depends on your cash flow position, and your stage of life and what other assets you might have. But if you're a younger entrepreneur just starting out, you built a business, I would argue that your first step to building wealth is building your asset base. And the best way to build your asset base is to borrow to invest in property. And the reason for that is good quality property provides most of its return in capital growth and very little income. And that's good for higher income earning entrepreneurs because you don't really want more income today. You're going to pay more tax. You'd rather your return almost all in capital growth because, of course, we know we don't pay tax on capital growth each year until we sell that asset. So we get to reinvest that return pre-tax without any tax liability, and we get to benefit from the compounding nature of capital growth.
Okay, so if we're going to focus on the property path, would it be more wise for us to focus sort of on an owner-occupier home or an investment property?
And this is a really important question, Mina, because, quite often we think, well, maybe we're better off buying an investment property because that's the key thing there is to build wealth. But in fact, a home can also obviously add to your wealth. In fact, I would argue, if you go and speak to a lot of Australians, obviously older Australians, probably one of their best investments has been their home. But the key reason to buy a home first is really tax. Because if we assume that property prices will incrementally increase over time, I don't think think that's a poor assumption. Of course, we know that if we want to buy our forever home today and it costs $2 million, chances are if we don't buy that today in 10 years' time, it's going to cost a lot more than $2 million, maybe four or something. So we need to use after-tax dollars to be able to pay for that home. Of course, we can borrow, but we've got to repay the borrowings at some point. The key thing I would like to typically do, or counsel clients to do, is buy the forever home as soon as possible. That's the first investment you should make. And I call it investment because hopefully we can apply an investment lens to it. That is, buy a home that's going to generate good capital growth, but in a location and type of asset that we want to live in. Now, that's not always possible, depends on where you're living, but it's often possible and it really is a great investment. The thing is, though, you might not be able to do it in one step. You might use a stepping stone strategy. So, buy an asset that is still a good investment property, but you can see yourself living in there for the next 5 years. So you can build up a bit more equity and cash flow and then sell that asset and then move into your forever home. But that's really, to my mind, the first cab off the rank.
Thanks, Drew. So if we're focusing on, you mentioned, location, the asset class, capital growth, what factors should sort of an investor really be looking into when they're looking into purchase a property that's investment grade?
So there's really three attributes that a property should possess to be considered to be investment grade. I mean, the first one is land value. The old saying that land appreciates, building depreciate. Buildings can depreciate, but the cost to replicate those buildings or rebuild those buildings can increase. And we've seen that, certainly over the COVID period since 2020, the cost to rebuild's probably risen 40 or 50% in most cases. So it's true that buildings don't always necessarily depreciate, but the greatest appreciation will come from the underlying land value. And so a property's value is a combination of the underlying land plus the improvements, the value of the improvements made on that land, the dwelling, of course. And so the key to investment grade property is you need enough land value to be able to offset any depreciation that might be happening with the property. So putting it differently, you want more than 50% of the overall value in land. Now, the next attribute is scarcity. So any land is just not good land. You want land located in a very scarce location. So scarcity is really supply and demand. Firstly, you want supply to be finite and fixed. That is, that there's no supply of available vacant land within close proximity to that location. So that means it's a built-up blue chip suburb. And we all know, there's no new blocks being released, a blue chip suburb. So you've got fixed supply. And then what you want is excessive and growing demand. Growing demand from a cohort of different buyers. It can be owner-occupiers, upgraders, downgraders, people trying to get into the market, investors. You don't want one cohort. You want multiple cohorts that are really all vying to live in this particular location. So that's the scarcity element. Then the other scarcity element can be with the actual improvements on the property. So if you compare two different types of property, a high-rise apartment in a high-rise building of 200 apartments in the building versus, say, an Art Deco house, just a Edwardian house, some sort of period property. One is not being reproduced ever again. The other one, you've got 200 apartments almost identical, and it's really who drops their price the first gets the sale, because you've got nothing that's unique with the property. So you want scarcity in terms of location and then scarcity in terms of architectural style. And the final element that makes a property investment grade is a history of strong returns. So that way, if we're looking at 13 Smith Street, we can have a look back at what 13 Smith Street has transacted over the last 40 years and impute a growth rate. We can then look at 11 Smith Street and 15 Smith Street, either side of the property if it's a comparable property, and see how it's transacted. And you can start building a bit of evidence in the immediate location of comparable properties to work out, has this had the attributes to drive capital growth? And the reason why past performance is so important is that the things that drive property value tend to be static and factual. Static in they very rarely change, or they can take decades to change, and factual as in it's a question of fact. Land size, location, locality towards or proximity towards the city, the amenities in the areas like schools, hospitals, shopping strips, these things don't change. And if they're present and they're of positive nature, then there should be evidence that it's driven property prices in that area. So just to summarize, more than 50% land value, you want scarcity and then proven performance.
So, assuming I've now purchased my sort of forever home or investment grade property, should I focus on paying down debt or reinvesting in my business or reinvesting outside my business? What should my next steps be?
I mean, it's impossible to answer this as a one size fits all kind of question. I mean, the real answer is it depends, but I guess that's not very helpful in a podcast format. I think probably for most people, it's a combination of all things. So I think if your business requires reinvestment and your business is doing well, you'd be silly not to ensure that it's got enough capital to be able to maximize value. So, that would be probably the first consideration. Then secondly, I mean, I don't think it's an all or nothing question in terms of debt reduction versus investing in other assets. Typically, I think that the best answer is to what proportion. And that's just going to depend on your age, your stage of life, other assets, the size of your home loan, those sorts of things. But I think most people would be well served to putting some of their spare cash flow towards debt reduction. So making sure they've got a profit distribution strategy that allows them to do that. And then also putting a reasonable portion of their surplus cash flow towards investing in the future. Now, that could be servicing investment properties in terms of negative cash flow. It could be investing in the share market, could be making super contributions, but whatever that might look like.
Now, I often get asked how you should really structure these investments. And again, like Stuart said, there's not always a one size fits all, but typically, if it's an owner occupier home, we would want to own it personally. And the reason being is we want to benefit from the main residence exemption. We want the land tax exemption as well. So we wouldn't typically use a corporate structure like a family trust or company. Now, if it's an investment property, then we still likely look at owning it personally, just so that we can get the negative gearing benefits. However, if we're looking at a share portfolio and it's becoming substantial, or will become substantial, we will then look at a trust or company structure. So that's sort of something to always keep back of mind as well. Now, if we're going down the share structure, Stuart, what's the simplest way to get exposure to global shares without spending a lot of time and money managing it?
So typically, what we see is people dabbling in the share market. Typically, they'll go and buy a few direct stocks first. Some of those direct stocks will work and some won't. And then they'll just think, well, what next? What do I do? That's a really kind of, if I like, an old fashioned way of investing in the share market. There's two types of sort of investment methodology, active and passive. Active would be, which stocks am I going to buy? And the whole idea is that you think you can go and pick a parcel of stocks and they're going to outperform the index. The index is like the ASX 200 index is just the top 200 companies in Australia and what that does. You're not required to be smart in order to get index return. That's available to everyone, right? So what we need to then do is benchmark performance. How has everyone performed relative to the index? That is professional managers and non-professional managers. And the data is overwhelming. Over various periods of time, about only 20% of fund managers beat the index. And it's not the same 20% either. The survivorship of that outperformance rarely lasts beyond 3 years. So if you're going to use active management, you've got to pick which fund manager, stockbroker, financial advisor is going to beat the market over the next couple of years. And then you've got to switch within 2 or 3 years and find the next winner. There's just no chance, right? Very little chance. So therefore, instead of finding the needle in the haystack, just invest in the haystack, which is the index. So there's a lot of ETFs and there's a lot of diversified ETFs now available. BetaShares and Vanguard are probably the two main players in this space. And a diversified ETF gives you immediate access to various asset classes and various geographical markets. But the benefit is the manager manages those allocations. So you don't need to worry about it. Leave it to the professionals. And so with one trade, like DHHG, for example, or DHHF, you can get access to international share market and the Australian market in one trade very cost effectively and very easily. And that's really, if you're planning on investing in the share market, that would be a great starting point, Mina.
Now, a lot of times we want to maximize our borrowing capacity, and we sort of need to look at different structures or what sort of appeals to banks when it comes to sort of maximizing borrowing capacity. So, things that typically often get asked is whether I should be sort of paying myself a salary or should I be sort of paying myself a dividend or retaining the profits in the company. Now, does it make any difference, Stuart, when it comes to lending?
I mean, it depends on the lender that you're using, but most lenders will just add back salaries because they're discretionary expenses, right? It's up to me how much I pay myself or whether I pay myself any income. That's going to be more of an account and tax planning question rather than a borrowing capacity question. However, it's really important that your accountant understands how lenders look at financials because how you might classify certain expenses will have an impact on your borrowing capacity and how you deal with particular items those income and expense items at the end of the financial year will have a big impact as well. So I think it's really important that, your holistic accountant works closely with your mortgage broker. Hopefully they're on the same team, but if not, works closely with them, particularly if your goal is to maximize your borrowing capacity. So if that's part of your plan, that's exactly what you want to be doing. And it's best to engage that process before your end of year financials are completed, and potentially even at the beginning of the financial year, in case you want to do something or change how you're dealing with a particular expense, how you're paying yourself, or all those sorts of things. And you want that to filter out through the whole financial year. You can never, don't leave these things too late, because obviously once they're set in stone, you can't necessarily go back and change it. The other little warning I would give is that don't rely on common sense because you and I might think, oh, well, this is how the business is operating. It's doing really well. And we can just have that conversation with a lender. Not all lending policies have any relationship with common sense. And, having been doing this business for more than 20 years, I can tell you, you can argue till you're blue in the face, but there's some credit policies you just won't get past, even if they're patently wrong. So again, it's about understanding the rules of the game and then trying to play to your advantage.
Now, lastly, as a young sort of entrepreneur or someone that's sort of starting out in business, super sometimes often gets neglected, or there might be sort of young entrepreneurs that start to think about self-managed super funds and investing within the self-managed superannuation fund environment. Now, the question then beckons as to, should I be paying or contributing into super whilst I've got a large debt? And should I really be using a self-managed super fund to invest or sticking to industry funds? So can you walk us through the options, Stuart, as to what option is used at what point in time?
Yeah, it is really common, Mina, and I think probably the issue most people have is they're worried that the government keeps playing with the rules. And I guess people that are attracted to being self-employed want more control over their life. That's probably one of the reasons why they don't want to be employees. So it doesn't really gel. Having said all that, I mean, they will change the rules 100%. They'll change them probably every year. We just need to make friends with that. The reality is, though, that it's always going to be concessionally taxed, and that each individual can have $2 million in super today that's going to be tax free. So if you, by the time you get to retirement, you're going to have $6 million and you've got a spouse, you want four of that $6 million inside super, that's tax effective. Now we've got caps, so we can't just magically transfer, $4 million into super at age 60. Therefore, it's important that we don't completely ignore it. So my answer would be, it's not whether you should contribute into super, it's really a question of how much. So I would say just put something in there, even if it's small. So even if it's just $5,000 a year, at least it's something to help the balance grow and you can gradually benefit from compounding capital growth. But if you are young and you do have a large non-tax deductible debt, look, probably super's not a major priority. You're probably not going to maximize the concessional cap, which is $30,000 a year. Maybe you put in $10,000 a year or something like that. Maybe something similar to if you were paid a normal market salary, so that you're not worse off by being self-employed in terms of your super balance. Because, blink and before you know it, you've been in business for 15 years and if you're not contributing to super, you might have very little super to show for it, and then you don't have a lot of time to catch up. In terms of self-managed super funds, look, it's a common sort of reaction. I'm self-employed, I'll set up a self-managed super fund, and a lot of accountants might recommend that. But look, I don't think a self-managed super fund is worthwhile unless you're going to buy direct property, whether it's commercial property for your business or residential property. Commercial property for your business might be okay, but I would caution about gearing into residential property, particularly if you're young. So otherwise, keep it pretty easy and simple, low cost. So an industry super fund like UniSuper is a good solution. If you start to accumulate a reasonable balance, look, you might speak to a financial advisor and have a wrap style product, because that offers some taxation benefits and some greater flexibility and transparency. I think the main thing here is make sure you're in a fund that's going to perform well, that has competitive fee environments, and don't ignore super.
Okay, I think that's enough rambling from Stuart and myself for today. I think that will sort of gives you an idea of what you should be thinking about if you're a young entrepreneur and trying to sort of build wealth outside of your business and sort of spread your eggs in more than one basket. That's all for today. Thank you. Until next week, bye for now.